Alright, so you want to start gambling, investing in 2023. That's great, and I think investing is one of the best ways, if not the best way, to grow your wealth over time. With that being said, it is a risky game if you're not careful and you don't want to end up losing your money while investing incorrectly. In this video, I'll be going over 5 major investment mistakes that you should never make and how to avoid them if you don't want to waste time and hard work growing your investment portfolio. Whether you're a beginner or an experienced investor, you always need to look out for these mistakes in order to not lose hundreds, if not thousands or millions of dollars. The first mistake many beginner investors do is invest in one sector or company. Basically, they don't diversify their portfolio. Getting emotionally attached to one company or sector is never a great idea, regardless of how strong their fundamentals are. Even if there's a company with great fundamentals, nothing's perfect and their valuation can still fall drastically in price. Take for example Meta. They were doing great, having a complete hold on the social media space up until recently, when their price fell 75% from about $380 to $100. Even though it had such a strong foundation, a few mistakes completely derailed its performance. The main reason on why you would want to diversify is to spread out your risk and not lose money in situations similar to Meta. For example, if something happens to the airline industry and planes were no longer a viable form of transportation, stocks in that sector would plummet. However, stocks in other forms of travel such as trains, ships, automobiles, and more would be much more valuable. Having stocks from all over the travel industry ensures that you are more or less protected from an event that can ruin one part of the industry. And the best and easiest way to diversify your investments is to invest in ETFs that cover the market. Some examples of these are VOO, SPY, VDI, and more. To even further diversify, you could have a look at other assets such as gold, bonds, and other commodities. The second big investment mistake that is becoming more popular these days is relying too much on advice from social media. Whether it's from Reddit or TikTok, following advice from social media is generally a quick way to lose most of your money. Look at this. On the Wall Street's Bet subreddit, one of the first posts I see is, "Am I doing this right? Minus 10K, 95% down." I don't know what to say, but if you don't want to end up like this, stay wary of advice that you see online. However, one piece of advice that you should listen to is to subscribe to this channel. Jokes aside, even taking advice from analysts could be risky to a certain extent. Only in late 2019 were financial advisors required to give advice to their customers' best interest. Meaning, before that, they probably gave advice that could have benefited them rather than their customers. Despite the fact that Warren Buffett is considered by many to be the best stock investor, he was reluctant to invest in technology when it was first on the rise.
If I had to bet on anybody, I'd certainly bet on Microsoft, bet heavily if I had to bet, but I don't have to bet. And I don't see that world as clearly as I see the soft drink world. Now, somebody that has a lot of familiarity with software may very well see it that way, and they're entitled to, if it's true they have superior knowledge and they act on it, they're entitled to make money from that superior knowledge.
By only following his portfolio and decisions, you would miss out on millions of dollars with a huge technology boom. All it really comes down to is using your own judgment. If you see some investing advice that looks interesting online, do some extra research to make sure you aren't setting yourself up for failure. While not all advice is poor advice, as an investor, it's important to do your own due diligence and figure out what will benefit you the most in the long term. The last thing you want is to see yourself losing thousands in a meme stock, meme coin, or worse, a pump and dump scheme. Everyone's interests are different, and generalized advice about specific stocks requires a lot of analysis. If some advice seems too good to be true, then it probably is. The third mistake, and arguably one of the biggest mistakes an investor can make with the stock market, is by having no patience when it comes to their investments. Due to the nature of stocks, they're going to be random to a certain degree, and they're going to have ups and downs. If a stock falls, as long as it has good fundamentals, it should bounce back. And panic selling won't do your time and money any justice. Leaving your money in the market is the best way to get consistent growth, and it allows your money to grow exponentially through compounding. If we take a look at SPY, the ETF for the S&P 500 index, there was a massive dip around March of 2020. If you had a position in SPY before that and sold out of fear, that would have been a horrible decision. In the following months, the entire market started to skyrocket with unprecedented growth. Peaks and troughs are just a part of investing, and is honestly just something that casual investors like you and I will have to get used to. Another smaller mistake related to patience is expecting to multiply your money overnight. If it was that easy, everyone would be doing it. Investing is not trading, and most individuals who day trade because they think they can 10x their money end up in a loss. Having realistic expectations can help you keep your money invested in safe investments for long periods of time. That way you can achieve the glorious $1 million portfolio. The fourth mistake is extremely common with new investors, and is that they try to time the market. All that means is that investors will look for a point where they think is probably the best time to enter the market. And don't lie to yourself, you've probably done this. And even if you haven't, I know I have. Between 1995 and 2014, the S&P 500 would have earned a 9.85% annualized return. However, without only 10 of the best days in the market, the return would have been 5.1%. If you were able to time those exact 10 days, I'd honestly think you have superpowers. Trying to time the market leads to emotional investing, whether you like it or not, because it taps into an investor's FOMO, or fear of missing out. It happened with so many investors who tried to get into the GameStop and AMC during that saga, but eventually left them penniless. You've probably heard the phrase, time in the market beats timing the market, and I completely agree. With the power of compounding, you can make so much more money letting your investments grow over time rather than constantly managed. In fact, according to research from Morningstar, only 23% of actively managed funds beat out the passive funds that let their money grow on their own. Timing the market is one of the most difficult tasks there is, and if these institutional investors who are getting paid hundreds of thousands of dollars can't consistently beat the market, why would you or I be able to do so? The last mistake, and arguably the most dangerous one, is investing more money than you can afford. While I've been saying that investing in stocks with good fundamentals or ETFs that track the market is a great way to earn money, it's never a good idea to invest in a financial instrument without the resources to survive with that money gone. As margin investing becomes more popular through brokers such as Robinhood, Fidelity, or Ameritrade, and more, it is more important than ever to make sure that you can pay back the money that you are being given to invest. In fact, one of the main reasons for the stock market crash of 1929, more commonly known as the Great Depression, was that people were investing on borrowed money. Stocks are always and will always be volatile. So if you're unable to live your daily life without immediately losing the money invested right now, I don't think you should invest all that money. There will always be a quote-unquote black swan events that you have to be ready for as an investor. Investing triggers emotional responses as it's related to money, and just because a stock is rising, don't throw all your money at it in hopes that it'll keep going up. To learn more about making money safely with stocks, I have a video about the best dividend ETFs right now. And if any of this information was useful, feel free to hit that like button.